The private credit markets are drawing a good bit of attention these days, with Blue Owl Capital being the poster child for the issues. A sector built on low interest rates and plenty of liquidity, the industry is hitting a bit of a rocky road right now, one that has some worry that maybe a bubble is forming. Itay Goldstein is professor of finance here at the Wharton School. He joins us to discuss what's been going on and what is ahead. Itay, thanks for your time today.
Thank you. It's great to be with you.
So we are seeing defaults, we're seeing redemptions. What is behind all of this in the private credit market right now?
Well, there is a lot going on, starting from all these funds giving loans that in the past banks used to give. But nowadays, given that banks are constrained, this lending is moving on to other intermediaries. And these are these private credit funds which are giving those loans. Now, those loans are typically not very liquid. So when you're giving these loans, you should not allow the underlying investors to be able to take the money out whenever they want. And initially, those funds were organized as closed-end funds, which basically means that investors cannot redeem. But over time, in order to attract more investors, they became kind of semi-liquid, they call it, which means that investors will be able to take some money at some point in time. And now, when you combine these things together, you have investors who want to take their money out, and you have the underlying asset, which is illiquid. That's kind of the old problem in finance. You're creating liquidity, and it works as long as it works. But then, if people lose confidence in it, then we start seeing this dynamic of a panic.
Right, because some of the collapses we've heard about are in a variety of sectors. So it's something within the structure of the company that is the issue with the loans that they're getting, correct?
Yes, I think there is a combination here. It is true that you see problems across sectors. However, I think what ignited the whole cycle is everything related to AI, and the fact that AI is now going to put software companies, which were once very promising, but now they're going to be put in trouble because of that. Many of these loans were given to software companies, so that's kind of the fundamental economic shock that ignited that. But then when you put it on top of the structure of private credit, with the underlying asset being illiquid and people have occasionally an opportunity to take their money out, all of a sudden they say they want to take their money out, and this is what sparked the flame.
The collapses, from what I read, also could potentially have downstream impact on banks and insurers as well.
Yeah, that is certainly part of the concern. The private credit funds, in and of themselves, might not be as big to cause a systemic concern. But the problem is that they are interconnected with banks and insurance companies. So some of the institutions that are providing the funds to these private credit funds to begin with are insurance companies and banks. And so the concern, and this is usually, when you start thinking about financial crisis, you know where you start, but you never know where it's going to end. It's kind of like a domino, and you never know how big the shock is going to be and how it's going to spread. And that's the concern, that some of the other institutions, banks and insurance companies, are going to be affected, and that might cause bigger problems.
So, in terms of Blue Owl, the first quarter saw a pretty sharp retreat by investors. Is this a little bit of panic setting in? Is the level of concern overstated, or is there a level of worry that really does play out here?
So I think it still remains to be seen, whether it's overstated or not. Uh, Certainly, it has some of the ingredients that are very familiar for people who are watching financial crisis and studying financial crisis. As I mentioned, there is a fundamental shock, in this case, AI and software companies. And then you have a structure that has some form of a liquidity mismatch. And once this takes hold, then you can start seeing redemption, and then because of interconnection, it can become bigger and spread throughout the financial system. So I would say it's still early to tell whether this is overstated or not. There is certainly a reason for concern. There are some factors that are mitigating the concern. I mentioned the liquidity transformation, but one thing we do have in this sector is they are not allowing unlimited redemptions. Unlike in
Yeah.
banks, if people come to the bank, everyone can take their money out overnight and the bank has nothing left. In this case, they're only allowing 5% every quarter and so on. So it's mitigated by this. And this is also what makes it a little bit of a slow moving panic, slow moving run, because people know they can't take their money out at any point in time. So they're kind of waiting. So I would say it's still ongoing. There was a panic in the beginning of the year, as you mentioned. Nowadays, it seems to be winding down a little bit. So hopefully, it will end without a big catastrophe. But I think it's still early to tell.
There's also, from what I read about this, the concern around some of the valuations that are involved here and whether or not the valuations are being overstated to a degree as well.
Yes, that is absolutely true. I mean, those loans in general are difficult to value. Those are private loans, and you need to make all sorts of assumptions about the viability of the borrower, about the likelihood of default. So those things in general are difficult to value. They're not traded on a frequent basis. So it's hard to tell exactly what the value is. And there has been some concern that all sorts of accounting issues might make this look better than it actually is. And certainly this is contributing to the panic. Now, with the closed end structure, you also get this feature that the underlying asset may be valued at some amount, but then when people are trading the shares of the fund, they're willing to pay less. And then you have this discount to net asset value where the shares of the fund are traded at a price that is lower than what people currently think is the net asset value. And we see those things in play now. And certainly they speak to the fact that there is a lot of uncertainty and concern about what is the underlying value.
So, Itai, obviously, the word bubble is being thrown out there. Is there a level of concern to that point that there is a bubble forming, or is that a bit of an overstatement, at least right now?
So there are many possibilities for a bubble. I think if you take a step back and you think about the overall stock market, there's certainly a big concern of a bubble there, and this is fueled by the large amount of AI investment that was going on over time, and what AI investment might also do to some other firms whose business might be disrupted because of AI. Um, Now, private credit could be a different kind of bubble, but it's certainly related. And if you're thinking about maybe there will be starting to see a crash in the stock market because of AI, or at least some decrease in valuations, then this can certainly spill over to what is going on in private credit, and those problems can then reinforce each other. So I will say, when people talk about a bubble, I think they're talking about it in a more general way than just private credit. Private credit is more of a structural problem with lack of transparency, with liquidity mismatch, and those things might contribute to each other. So I would say private credit is probably part of the big puzzle of the overall fragility that we are exposed to right now in financial markets.
Right. So, what do you think is kind of the state of the private credit markets at this point, and what then do you want to see play out as we move forward here?
I think overall the state of private credit is probably not great at the moment because there was a lot of enthusiasm about it before the recent episode. People saw that as a booming area and kind of a new way to provide credit and overcome all the difficulties that we have with the banking sector. But certainly everything that we saw now gave a lot of people pause. I think it'll take some time for the private credit segment to overcome all these concerns, all these doubts. It'll certainly take some time. Whether we see a big crisis or not, I think certainly the seed of doubt is there, and
Right.
people are gonna hesitate more before putting more money into it. So I would say overall it doesn't look as good as it did before the recent episode.
Itay, great to talk to you again. Thank you very much, sir. All the best.
Okay. Thank you very much.
Thank you. Wharton Professor Itay Goldstein.